Okay, let's dive right into this explainer. Today, we're taking Leon's Furniture, ticker LNF on the TSX, and putting it through the ultimate analytical gauntlet. If you're here, it's because you want to move beyond surface level metrics and truly figure out how to value a business. So, we're going to pull apart the financial DNA of this company using their May 2026 investor presentation, dividend history, and market reports. We'll pass all this raw data through the uncompromising frameworks of Warren Buffett, Benjamin Graham, Peter Lynch, and some strict quantitative modeling to see if it survives. Here's the roadmap for our analysis. We'll start with a quick snapshot of the company, then look at it through the lenses of Buffett, Graham, and Lynch, before crunching the numbers with a DCF and alternative models. Finally, we'll wrap it all up with our synthesis and final recommendation. Part 1. LNF Company Snapshot and the Baseline Metrics. So, who exactly is Leon's Furniture? Well, they are literally Canada's dominant home retailer. We're talking 299 stores coast to coast, operating under massive banners you probably know, like Leon's and The Brick. They sell furniture, appliances, electronics, and they also run an incredibly profitable commercial and after-sales service division. This isn't some flashy speculative startup, right? This is a massive, entrenched brick-and-mortar operator. And here is our starting line. The stock is currently trading at $23.80, giving it a market cap of $1.64 billion. But look at this. It offers a massive 12.38% dividend yield and an attractive PE ratio of just 10.6. With an earnings per share of $2.25, on the surface, this just screams value. But, we really need to dig deeper to make sure we aren't walking blindly into a value trap. Moving on to Section 2. The Warren Buffett lens: quality, moat, and management. Buffett loves a dominant footprint, low debt, and a deeply aligned management team. Well, LNF's massive, comprehensive coverage across Canada acts as a serious economic moat against smaller regional players. Then we look at earnings consistency and see a really solid return on equity of 12.47%. But the real kicker here? Their debt levels are fortress-like. We're talking a debt-to-equity ratio of just 0.32. Plus, insiders own about 70% of the company. That kind of serious skin in the game is exactly what Buffett looks for when hunting for honest, competent management. So let's do the math. If we calculate an approximate intrinsic value using a modest 15 times multiple on that consistent $2.25 earnings per share, which is a multiple Buffett often assigns to high-quality, slow-growth businesses, we get an owner earnings baseline of $33.75. Now, apply a strict 25% margin of safety to that, and we land on a firm buy target of around $25.31. Since the stock is currently sitting at $23.80, LNF actually clears the Buffett hurdle with room to spare. Now, you might be wondering, Buffett might be interested, but what about the father of value investing? Would Benjamin Graham touch this stock? We know the qualitative mode and management metrics are there, but we really need to figure out if the underlying asset protection is strong enough for Graham's ultra-conservative standards. That brings us to Section 3, the Benjamin Graham lens, the defensive investor checklist. Let's run this point by point through Graham's defensive checklist. Honestly, LNF passes flawlessly. Adequate size? Yep, it's well over $1 billion market cap. Strong financial condition? Absolutely. They boast a current ratio of 1.56 and a stunning $303.1 million in net cash. Earnings are completely stable, and that dividend record is just unquestionable with that massive 12.38% yield and a solid history of recent raises. And finally, with a PE of 10.6 and a price-to-book ratio of just 1.34, it easily checks the box for moderate valuation. To pinpoint Graham's exact buy price, we use his famous intrinsic value formula. It's a highly conservative valuation, calculated as the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. Let's break down the math on this. If we take that $23.80 stock price and divide it by the 1.34 price-to-book ratio, we uncover a hard book value per share of $17.76. Now just plug that into the formula alongside the constant of 22.5 and the $2.25 EPS. And the formula spits out a Graham intrinsic value of $29.98. Guys, this is absolutely massive. It means that at today's $23.80 market price, a strict Graham value investor gets an automatic, built-in margin of safety of over 20%. Graham wouldn't just touch the stock. This would trigger an immediate screaming buy signal on his screener for sure. Next up, Section 4, the Peter Lynch lens, growth categories and catalysts. Looking through the Lynch lens, he'd likely categorize LNF as a bit of a hybrid, a classic asset play mixed with a stalwart. Why an asset play? Well, because there is this massive hidden value sitting right there on their balance sheet. LNF is actually planning a REIT spin-off of 429 acres of prime real estate holdings. It's crazy how often Wall Street completely misses the value of land owned outright by retailers. Plus, Lynch absolutely loves it when there's low institutional ownership combined with high insider ownership. With insiders holding about 70% here, management's wealth is literally tied directly to the shareholders' outcome. Now, we know Lynch also heavily relies on the PEG ratio. That's price to earnings relative to growth. Right now, LNF's PEG sits at a rather high 5.67, which tells us recent top-line growth has definitely slowed down in what's currently a cyclical retail environment. But Lynch would almost certainly argue that an absolutely phenomenal 12.38% dividend yield, which is fully backed by cash, heavily mitigates that growth risk while you wait for the real estate catalyst to unlock all that hidden value. All right, Section 5, DCF and Alternative Valuations, Strict Quantitative Modeling. Okay, let's pivot from philosophy to strict math. Because precise multi-year forward free cash flow estimates aren't strictly published for LNF, we went ahead and modeled a base case DCF using their robust 14.55% free cash flow yield. That translates to about $3.46 in free cash flow per share. We assumed a conservative 3% growth rate over 5 years, used a standard 9% for the discount rate, or WACC, and factored in a 2% terminal growth rate to reflect perpetual maturity in the industry. And you can see here how this model reacts when we stress test it. Even if we toggle the discount rate up to a strict 10% and drop terminal growth down to 1.5%, the fair value still holds strong at $29.40. But under our highly reasonable base case parameters of a 9% WACC and 2% terminal growth, the fair value anchors right at $35 per share. The math here is incredibly supportive of the current stock price. Just to be absolutely sure, let's apply 2 alternative models. First up, a zero-growth dividend discount model. If we take the roughly $2.95 annual payout, which gives us that 12.38% yield on the current price, and apply a strict 10% discount rate, assuming zero future dividend growth, we still walk away with a fair value of $29.50. Second, if we run comparable company PE multiples against consumer cyclical peers, the valuation aligns almost perfectly with the current Wall Street consensus target of $33. Finally, Section 6, Synthesis and Final Recommendation, the verdict. So what does this all mean? When we line up these calculated intrinsic values side by side against the current $23.80 stock price, it paints a pretty undeniable picture. Gram value sits at $29.98, Wall Street comps are at $33, and base DCF comes in at $35. Every single rigorously applied model suggests this stock is currently undervalued by a significant margin. Blending the insights from our gurus, the investment thesis really solidifies. Sure, there are risks, right? The retail environment is notoriously cyclical, and top-line growth is a bit sluggish right now, but you have a fortress-like balance sheet, a staggering 12.38% yield, 70% insider alignment, and that impending real estate spinoff catalyst. All of this leads to a definitive buy opinion at today's price of $23.80. It triggers a buy for Buffett under $25.31, and easily triggers a buy for Graham under $29.98. So it leaves us with one final, provocative question to consider as you look at your own portfolio. With insiders tightly gripping 70% of the shares and happily collecting a double-digit yield, is Wall Street severely underpricing this hidden real estate empire sitting right underneath Leon's retail footprint? Definitely something to think about. Thanks for tuning into this explainer, and happy analyzing.